Hello, everyone, and welcome back to another week of our live show. It's good to be back with you guys. I know I was not around last week as it was my son's birthday, so kind of took the week off, did some fun things that he kind of ran the week there. And for those of you that are parents, you kind of know how that goes with younger kids. So it was a good little break, but happy to be back with you guys. Hope you guys are all doing well. It seems like every time we miss a power hour time, it's something happens in the market. You know, we get a big jump in the market, we get a big drawdown. Well, last week was that big drawdown that we've been talking about. For those of you that have kind of showed up in this for our investing power hour for some time now, we've kind of a few trends that we've talked about is the pullback we've been waiting for, the diversification, and then the value play in REITs, and all of those things have lined up exactly how we've been looking for them to play out from that standpoint there. So hope you guys are all doing well. If this is your first time joining, my name is Mark Rusin. I'm a CPA here in the state of California. Let's start off by letting me know who is out there, who's watching, where are you watching from, and what are some stocks that you have or ETFs that you have recently added to your portfolio. Let us know in the comments. This is meant to be, intuitive in the fact that let's get a discussion going. Let's ask questions. Let's talk about what you guys see in the market. I have a whole slew of things that we'll be going through today as well. So who do we see out there right now? We got Scott, upstate New York, bought some VTI on the dip. NVIDIA is tempting to get back in as well. George, how you doing? Good to see you. Matthew, always great to see you as well. Drew, checking in from Minnesota. McVeigh checking in as well. Tran, how we doing? Chi-Town in the house. Shiva from Texas. Baltimore with Chris. Alabama with Adam. Bought some VOO and SCHD. Can never go really wrong with either of those ETFs there. What's up, Mark? Ty from Seattle. The dip was a big lesson in what you've been telling me about keeping cash reserves. I've been DCAing all my funds, got to save up for dips. And that's why it's really important. I tell this with all of my students where I go through my 6-week investing accelerator course, that we always want to do our due diligence ahead of time. And we want to create that watch list. We don't want to just jump into stocks and then go do our due diligence because they appear cheap. There could be a lot of stocks that appear cheap, but they're cheap for a reason. We've seen that with the likes of Nike. We have seen that with the likes of Starbucks. And boy, did Starbucks have a resurgent day yesterday on CEO news, which, you know, we're going to talk more about that in today's power hour that we have as well. So a happy shareholder at that there. Who else? Cindy is also in the house from Missouri, bought some VYM. So it's a high yield ETF. Realty Income, Agree Realty, and Vici. John is in the house. Nice to be able to make it. There we go. Another Minnesota. Tucker, Georgia, and NVIDIA. So we got Georgia's in the house as well. HUD from Cape, Florida, picked up some OHI. So going REIT shopping there. Jim Betts, good to see you with an updated photo there. Look at that, Jim, from Nebraska. Bought ET so far this week, looking at Mondelez, ADC, GD for the rest of the week. Awesome. Love it. James, good to see you. Portugal's in the house. McVeigh, what are we buying? Visa, Pfizer, and some Realty Income. Love that. All right. What are we buying here, Ty? Amazon, Alphabet, JP Morgan, Avi, Mo, Vici. Wow. Someone's been taking a peek at my portfolio right there. I like all those names. The only one I don't own of that is going to be JP Morgan of that group there. Seminole, Florida. So far, Florida. Jeffrey Hatch, good to see you, my friend, from Washington. No buys last week, just a few option plays. You love it. Love to see those option plays. John Bircher, good to see you, my friend from Tulsa. VTV, someone must have watched our latest video there. Little value ETF play. Can you check out the stock OMF for me, please? We'll try and see if we have some time to take a look at that one. Cape Coral used to live off Chiquita. Hello, Mark from Maryville. Awesome. Great to have you. Brazil's in the house. Went to CC High School. Go Seahawks. Are JEPI and JEPQ good passive income investments for long-term perspective? Limited downside with 8 to 9% yield is tempting. So I have a love-hate relationship when it comes to JEPI and JEPQ. And the reason being is I look at these as short-term investments. If I have a large cash position right now, instead of it just sitting there, I'll throw a good portion of it in something like JEPQ. That's what I've done over the past 3 or so months from that standpoint. However, recently sold that, needed to put some more cash to work. Now I've built it back up, so I may be looking to return to something like JEPI or JEPQ. Just not something that I'm going to hold long term. I look at them more similar to fixed income. Now, they're not fixed income. They can fluctuate. They hold underlying assets, but they do option plays, covered calls. So when you do just that, you're able to juice your premiums, but at the same time, you also can limit the upside depending on if those option plays go against you from that standpoint there. So it's a love-hate relationship, not anything that I would have in my portfolio for the long term from that perspective. Man, I bought a mini Ulta position, and now Mr. Buffett makes it fly. I saw that a second ago that Buffett had, and we'll be looking at some of his buys. And I saw Ulta, but I didn't have a check to see what it's doing after hours. Look at that, a 14%. Man, that is just something special right there as it pertains to Ulta. Pick some Nvidia up right below 100. Can't complain about that. Been taking your advice, Mark, for sure. Awesome. Just trying to educate as many people as we can here, because we all have one goal in common. We're all looking to build wealth, and what I hope that will be generational wealth for you and your family moving forward. Sold out of most of my portfolio on Friday before the Black Monday, and terrified to enter again. Got out of it completely. Wow. Alejandro from Costa Rica is in the house. Nice. Look at all that. Singapore. Sean, good to see you. Bought some FDVV. Egypt is in the house. Holland, Michigan. I have a nephew named Holland who was named after Holland, Michigan there. Never miss your videos. What do you think of Starbucks' new CEO? Well, we are going to go over that today, so don't you worry. Jim says Deere is expected to post dismal earnings tomorrow, but Wall Street seems to think it will take off 2025 and beyond. Thoughts? So I've been taking a look at Deere. No position right now, but I believe that kind of what you're saying is real. Is the market and the analysts believe that, hey, these are going to be dismal earnings. And part of that makes me kind of excited. Again, now no position in it right now, but part of me wants to get into it for the fact that, and I can't now, obviously the market's closed, but when expectations come down so much, that lowers the bar that much more for a particular company. Look at it on the flip side. Look at all of these high flying pre our Black Monday that we had the other day, August 5th it was, when the market just completely tanked, and that was more over the Japanese currency issues there. But you have, especially going into this earnings season that we just got through, you had these multiples that were so stretched in terms of valuation. You had earnings expectations that were so high that some of these companies were meeting expectations, and the stock price fell back because they were already so high. Analysts were really hoping for them to surpass those expectations based on valuation. So Deere is the flip side of things. They are a stock that's been falling. Their expectations from analysts have been falling a ton. They're expected to report terrible earnings from that standpoint there. And it's a very cyclical company. So you have to ride the waves when it comes to the cyclical type companies, Deeres and Caterpillars of the world. They really need the economy to be working. But I like Deere as that kind of, there's a technology agriculture play to it. I used to call it the Tesla of agriculture, with all of this software that they're putting into a lot of these tractors, where they have self-driving tractors now, believe it or not, from that standpoint, that you can keep on a field. They're not going to be going down a bunch of roads or anything like that, but you can keep them on a field and working based on the latest technology. So I like Deere. Again, no position right now. Going to take a wait and see approach. Just kind of my 2 cents as it pertains to Deere there. Magic Man picked up some Nvidia at 104, wondering if I should pick up some more ahead of the conference call. So earnings season, it's behind us, except for Nvidia. That's kind of the one big one that we have left, with 90+% of the S&P 500 already having reported its latest earnings report. So at this point here, I own Nvidia. Going to try and just take a wait and see approach. It's another stock that, although it's off of its highs by a good deal, I still believe that expectations are extended, just due in part that look at the results that they have printed in the past few quarters. A lot of people are saying, can they do it again? And if they don't, we could potentially see a stock fall from that standpoint. But they have seemingly not let us down in some time there. So what do you think about oil and natural gas companies? So when it comes to those types, I have an ETF that I typically play called IEO. I believe that's, let me make sure I'm giving you the right one. John Bircher usually corrects me if I'm incorrect on that position there. Yep, IEO is the name, and this is an oil and gas ETF. So again, I don't follow the energy sector all that closely, So when I want to play energy, I'll play XLE. If I want to play more specifically and pull out the likes of ExxonMobil, pull out the likes of Chevron, I go to an ETF called IEO, which is going to be predicated on oil and gas there. And obviously, it's going to be have movement based on the price of oil. So that's the way I play that sector right there. Chi-Town is in the house. There's John right there on XLE. So energy is going to be, it can be to a degree an area that is defensive. And I think that, I always want to have some exposure to the energy sector from that standpoint. I think energy is going to have, is going to be really dependent on this coming election. You got one candidate that's going to be pushing more for energy, particularly more oil and gas, and another candidate that's going to be pushing more for clean energy and less on oil and gas, less on drilling in that. So whoever wins between that is really going to determine which direction some of these particular energy companies go from that standpoint. Jeff, great to see you. All right. A lot of great questions here. My mark still big on Pfizer below 30. That's been my saying from that standpoint. We got above it. I think we got to around $31 or slightly below that from that standpoint. We're getting another dip in it right here. So I like Pfizer below $30 long term from that perspective. So let's jump in. So we don't have any specific formal slide deck because, we did it without slides last time. A lot of people liked it that way where we were using the iPad or using the other screen and things like that. So we're going to be dipping back and forth between the other screen, but we're going to typically go through some of the key things, key stories in the market. Right now, we're going to take a look at a recap of the major indices right now being the S&P 500, the Dow Jones, the NASDAQ, as well as the Russell 2000. So let's begin by, let me share my screen with you guys. So as you can see here, looking at this white charts, this is a year to date based on those four major indices right now with the S&P 500, the Dow Jones, the NASDAQ, and then we threw in the Russell 2000 there as well. And as you can see, year to date, we're kind of neck and neck between the S&P 500 and the NASDAQ. Well, technology has ruled the world. Again, here in 2024, those are the top positions in both the S&P 500 as well as the NASDAQ. So no real surprise from that standpoint there. Although, look how high we were on the NASDAQ and how far we have fallen so far. I think that's going to be one of the takeaways there. We see the Dow Jones is up about 6%, and the Russell 2000, after getting up as much as 10%, only held that for a few weeks from that standpoint before falling back down to pretty much even, up 3% on the year so far. Let's take a little bit closer and look out over the past 6 months from that standpoint and see where things are. Well, the S&P 500 now is going to be leading. Why? Because we have started to broaden out. We've seen that tech trade, the big technology, mega cap stocks. We've seen a little bit of diversification, selling those and adding to other areas, something we've talked a lot about on this channel here and during our power hour time together. And we could see that the Russell has gained some momentum in the past 6 weeks, though, or the 6 months there, up nearly 7%. Let's broaden in and get a little bit closer to see, okay, how about the past 3 months? We have the NASDAQ up roughly 5%. So they kind of bottomed out right around even on the past 3 months there, being up as much as 12% at one point. And if we go over the past month, what are stocks doing? Yep, we have stocks that are in the red. We have the NASDAQ down 6.5%. We have the S&P 500 down 3%, small caps down 2.5%, and the Dow Jones eking out a slight gain there at 0.02%. So pretty much even. You could make a case and say, all of these four major indices are actually down on the year so far. So that's where we stand in terms of where the market is right now. Let's take a look at something else here. And let's take a look at the charts. And what we're going to do here is I'm going to show you this is the S&P 500 as a whole, the total index, not the SPY, but the S&P 500 as a whole. So looking here at TradingView, we could see that the S&P 500 back in July hit a high of 5670, and that was on July 16th at that. So right at the midpoint of July there, we hit 5670. From that day forward, though, we started our decline here. I would say slow descent, but it was more like a crash landing to a degree, something we've been waiting for. We've been talking about valuations being extended. We've been talking about we need to see at least one of those corrections per year. On an average, we usually get one correction per year, which a correction is usually a 10% pullback from recent highs. The last time we saw somewhat resemblance of a correction was back in April, but that was only about 5%. Lo and behold, we went from 56.70 all the way down on August 5th after that debacle there. It was short-lived, but that was about 9.7% from the top of that period all the way down to where we were at the bottom of August 5th for the S&P 500. So that puts us right there at our 10% that we've been talking about from that standpoint there. Now, there's something else I want to talk to you about. And it's, I'm not a day trader, but this is something that maybe some of you can learn for those of you that do utilize charts from on a regular basis here. And when looking at the charts, you could see that there's a rule that's out there for some of you that do more day trading type things or base off the charts here. There's a rule called the 50% retracement rule. And the best way to describe that is when you see a large pullback, and it can go both ways. It could be a big jump to the upside, or it could be a big downside protection here overall. But we saw a large drawdown in the market here. So now what we're going to do is our top line, our high point is going to be our 100% line. And the bottom of where August 5th bottomed out is going to be our 0% line. So when you have those big drawdowns, you want to look at that area, that period of a 50% retracement, 50 to 60% if you use those Fibonacci rules that are out there. And the reason being is this could be an area of resistance after a big drawdown. You'll see that drawdown. It'll bottom out. We'll find some support, which we did at 51.20 is where it fell down to on August 5th. And now we want to say, okay, that was a 550 point drawdown from top to bottom on August 5th, from July 16th down to on August 5th there, 550 points. So 50%, to gain 50% of that back is going to be roughly about 200 and some odd points there. 50% is exactly where we're trading at today, based on the drop from July 16th all the way down to August 5th. We have now retraced and regained 50% of that loss. So we're kind of at that ticking, and you don't necessarily want to call it a ticking time bomb per se, but a big area on which direction the market can go. Typically, that 50% retracement is an area of resistance, and we could see the market fall back from that here in the coming week. So let me show you that rule right here in a different term. So it's called that trading the 50% retracements with price action. Let's look at an example down here. This is pretty much what the charts look like right now for the S&P 500. You could see this is the 100% at the peak of where the markets were. We saw a big drawdown in the markets, and then they found a level of support. Well, that bottoming is going to be our 0%. We now need to see what is the difference between the top and the bottom and find where is our 50% retracement from that standpoint, which is going to be kind of where we're trading at right now. So you could see that looking at this rule, we see it come up and then boom, we hit that 50% level, which tends to be an area of resistance. So something to keep in the back of your mind. If you were saying, hey, I want to put money to work right now, probably something I want to see some further movement in the stock here. Is this an area of resistance? Are we going to fall back and probably get lower prices? That's what I'm thinking from that standpoint right now, at least in the near term. Or are we going to bust right through this and go and test the highs again of the S&P 500? So I'm waiting and trying to be patient, seeing that we're at that 50% retracement level right now. So that's where we're at on the charts right now. Now let's move on to Starbucks. So when it comes to Starbucks, you may or may not have heard that they've been in the news lately, and they hired a new CEO. And the other day when I woke up and read the Starbucks news, being a Starbucks shareholder myself, I loved this news. I didn't even think this was a possibility. Brian Niccol, the ex-now CEO, or still current right now, not until September 9th, I believe is the time where he switches over to be the Starbucks CEO and chairman. But he is the top beverage restaurant CEO pretty much in the world right now. He led the likes of Yum Brands, Taco Bell, so obviously very familiar with restaurant. Then he moved over to Chipotle, which CMG shares under his leadership are up nearly 800%. He started back in 2018, I believe it was. So they're up, to be exact, roughly 775% under the leadership of Brian Nickel. I never thought this was even a possibility. And Locksman, who came on, didn't really have, he had the beverage side of things experience, but didn't really have restaurant type experience. And we look at Starbucks as a restaurant type from that standpoint there. So obviously it didn't work out. Obviously it was only a year. So he had a very short lease from that standpoint. And I think Starbucks would have let him kept going and not pulled the plug that fast unless there was only one man available that would be interested in taking that job. And it was this guy right here, Brian Nickel. This is the person, the perfect person to lead a company like Starbucks, who's really gone nowhere. Starbucks has literally done nothing in terms of results, in terms of their expansions and things like that, losing market share. The other day I was out in Arizona, went by a Starbucks. Starbucks had roughly 4 or 5 cars in the drive-thru. Probably less than 2 miles down the road was a Dutch Brothers. You may or may not have heard of Dutch Brothers before. Stock ticker BROS, Bros. This company, another coffee chain, don't sell food, pretty much just a drive-through. There's no seating area. They had over 35 cars in the drive-through. I went to go get coffee there and ended up saying, I can't wait that long for coffee. I did end up going to Starbucks, but I've drank the Dutch Bros coffee before, and it is fantastic. Now, if you're looking at the stock, it is quite expensive. They've been growing at a rapid pace, unlike Starbucks, which has been really muddling, going nowhere, seeing reduction and a slowdown completely in traffic due a pushback from higher prices from that standpoint. But CEO Brian Nickel, he's got a lot of work to do. He's got a big turnaround to do. It's not going to be something that's going to happen overnight. Is a 24% move in the stock a little bit overstretched? Probably. And when I saw that yesterday, I bought some puts, played some options, sold some credit spreads from that standpoint, trying to, I love to sell covered call like plays, but didn't want to get rid of any of my shares. So I did what's called a credit call spread from that standpoint. Still generated some income from that based on that trade, and it worked out pretty good given the fact of where Starbucks was today there. So really excited about this hire here. So let's go over some of the stats that we have here for Brian Nickel, because he is getting paid a pretty penny to come be the CEO of Starbucks. So here's a look at his base salary as it stands here. So Starbucks, Brian Nickel's base salary is going to be about 1.6 million. A signing bonus of 10 million. I feel like I'm like reading a article on ESPN right now about a new wide receiver that just signed a $10 million contract from that standpoint. So 1.6 million base. He's getting the 10 million signing bonus, and he's getting $23 million in equity grants. So roughly $35 million is his pay package for the year 2025. What would that buy you? That would buy you nearly 5 million cups of coffee at $7. So that's a lot of coffee, a lot of Starbucks coffee he'll be drinking in the near term. But that's not all. In addition to that, he is getting granted $75 million in equity grants. Now, 23.5 of that or so, 23 of that I already mentioned. So on top of that, the whole package together is roughly 80 some odd million dollars altogether. That is a big chunk of change there. So why the big equity grant? Well, he's having to leave some money on the table based on leaving Chipotle. So when you get granted equity awards, they're going to be tied to stock performance. They're going to be tied to how long you're staying with the company. So if they grant you, let's say these 75 million, right now they're saying he needs to be at Starbucks as the CEO for the next, I believe it's 3 to 5 years. And on top of that, there's financial things that so it's in the best interest of us as shareholders at the same time, because he can't just come on and do nothing and just be lazy. He needs to turn this company around if he wants to get those equity grants, the majority of those equity grants from that standpoint there. So let's see what's going on from that standpoint there. Hello, Sunny Man. Good to see you, my friend. What are our thoughts here on Starbucks? Do we like the hire? Did we overpay? What are your thoughts? My Starbucks shares and I danced all the way to my local Starbucks. I only have a water in this. I had a drink in it before, but I just had to keep my Starbucks cup for you guys right there. So there we go. Although it has water, still got the Starbucks cup. Special day for us shareholders, even though it gets us pretty much back to, digging out of a hole there. So, all right, Cindy, my Starbucks shares and I danced. We saw that one. Okay. Everyone got 122% on Starbucks. Sean, after reading the news of Starbucks, I would want to do my own valuation on Chipotle. To me, Starbucks looks overvalued right now. Yeah, everything that had to do with that big move in Starbucks yesterday was solely based on that hire, had nothing to do with fundamentals. And when you look at the next, even after he takes over the helm on September 9th, it's going to be another year or so until you can really evaluate it. That's how long we gave Loxman. And the company really went in reverse. So it'll probably take a few quarters for him to start coming and implementing some new ideas. But I have all the confidence in the world that we are going to see a new Starbucks 12 months from now. Now, does that mean the share price is going to be exponentially higher? No, but I'm looking at it from a fundamental perspective, from a financial perspective, the balance sheet and the cash flows and efficiency standpoint there. There's going to be some growing pains overall, but I believe that we're going to see a revived Starbucks 12 months from now from that standpoint there. So I loved everything about that. Jeff H, but bros, I'm down 28% in the last month. Yep, very volatile. When you start dipping into those high multiple stocks, volatility comes with that. So you got to understand that when you jump into those high multiple stocks there. So let's take a look. I'm going to take a look at bros really quick from that standpoint. Love my Starbucks, Maria from New York. Love it. All right, so let's take a look at bros. Let me share the screen here so you guys can see it. So here is Dutch Bros, and you could see that the stock got up to a high of, what is that, $43 and change. This is the stock that at the end of September last year was trading at $20 or so, in the low 20s. So they essentially grew they doubled, grew 100%. Well, in the last 6 months, call it, or let's call it a month, shares have come down a ton. And one of that was on August 8th, where they fell from 38 down to 28 from that standpoint. What happened there? You can see it right here. Earnings happened. Growth may not be growing as fast as it once was, but look at this multiple, a 73 times multiple. That is a very high multiple to pay for a particular stock. And when they don't meet expectations and they're not growing as fast as they analysts thought they would, those companies are going to get hit quite hard. Now you go over here to Starbucks, and you have now after that big jump yesterday, this was a stock that was in the low 20s, is now slightly at 27 times on a PE multiple there. So a lot to like overall. So that's where we're at with Brian Niccol. Let's see where he's coming from. So this is how much he was getting paid at Chipotle. So he had a base of right below 1.3. His new base is now 1.6. You could see his total package here was 22.4 overall. It's now for this next year 34.6. So that is a sizable jump there overall. In addition, he's going to get those additional equity grants there. So you're getting 75 million. Of that, I included 23 million will be granted in the year 2025. So Brian Niccol, he's in a good spot from that standpoint there. So we just talked about that. Where are we going to go now? Let's transition on to CPI. So now we're going to go back to economic news. And that's been the talk of the tape here the past few hours and day, I should say, in terms of annual inflation coming in at the lowest rate. This is kind of what everyone was focused on going into this particular week. We had a few earnings reports. We saw Cisco, we've seen Home Depot, but this is what people were focused on. Two things, CPI and jobless reports tomorrow is what I am at least focused on as an investor here. So annual inflation came in at 2.9% from that standpoint there. That's the lowest we have seen since 2021. All good news from that standpoint there. Core CPI grew at 0.2%. That was the same for regular CPI. So in it, not the way you should do it, but you could annualize that moving forward at a growth rate of 0.2%. If it stayed roughly on average around 0.2%, and you annualize that over the next 12 months, we're talking about an annualized rate that's sitting at 2.4%. That's right where the Fed is looking. Now, CPI isn't the number one metric for inflation that the Fed is focusing on, but it is a top one because obviously it is inflation that we want to focus on. However, when it comes to calculation of CPI versus some of the other inflation reports, one of the ones that a lot of people have a lot of gripe about is shelter costs and how those are calculated as it pertains to CPI. So as you can see here, shelter costs, which increased 0.4% during the month, that was responsible for 90% of all the items inflation during that particular month, which was July from that standpoint. So some things that we want to look at there overall is how do they come up with some of these shelter costs? Well, one of the things that they focus on is called OER, or owner's equivalent rent. So they could see some of the rent data. If there's apartments that are being rent, okay, how much are you paying for this particular unit? If there's a home being rent, how much are you paying for this particular unit? And they'll kind of spread it across that area. But as you know, rentals can be all over. There could be a ton more. Obviously, in big cities, there's going to be mostly rentals rather than the ownership of homes there. So what they do is they kind of say, okay, if you were to rent your home, even if you're owner occupied, they're going to say, how much would you charge for that particular home? So there can be a lot of, differences of opinion, differences of prices, and it can really sway and move it. So I'm not a big proponent of CPI from that standpoint there. I'd rather look at some of these other inflation metrics, and that's some of the gripe that goes on as it pertains to inflation there. So now let's transition and look at some of our jobless claims. So the jobless report is going to come out tomorrow. So we'll see jobless claims, continuing claims from that standpoint. And we could see that we hit an 11-month high in the past week or so, past few weeks from that standpoint, but that drastically fell in the latest report. Now we're going to get an update, and this is on weekly jobless claims. So we're going to see where that number is going to come in here tomorrow, and that's going to be very telling on where the economy is going. So we've seen inflation coming down. We have seen jobless and the job market, which tended to be quite strong, really weaken over the past few months. Jobless claims are increasing. They were just at an 11-month high. Unemployment has gone from the low 3% range to now being at 4%, in the near mid 4% range from that standpoint. So more folks are losing their jobs. Economy is slowing. Growth is slowing for businesses. Rates are still high. So what needs to happen? The Fed needs to cut rates here in September, and that's exactly what people are looking for. So the next Fed meeting is going to be on September 18th. So roughly about a month ago, or a month ahead from that standpoint here. So we'll probably have four more meetings of our power hour here, our investing hour, and we'll get to talk more about the Fed. So right now we're sitting at a range of 5.25 up to 5.5. And as you can see here, no one believes that we're going to be at the same spot come September. 63% believe we will get a 25 basis point cut, and 37% believe we will get a 50 basis point. It's no longer a talk of is the Fed going to cut rates in September? It's more the discussion is now focused on how much are they going to cut in September. So this is something that if you've joined on a regular basis, what has been my position? My position has been at least 2 rate cuts here in the back half of 2024. I believed one was going to come in September, and I believe the next one's going to come in December. Still looks like it is going to play out that way based on my feeling from that standpoint there. So let's see where probabilities are based on moving forward. So as we could see here, again, we're at 5.25. So 64% believe we are going to come down at least 0.25%. But by the time we get to the November meeting, 46%, which is, the majority overall, believes we will get down to 4.5. By the December meeting, the majority believes we will be at 4.25. So 100 basis points worth of cuts between now and the end of the year. That means that's pretty much counting in 250 basis point cuts for the remainder of the year from the Federal Reserve. And that's going to have some impact on the overall economy. It's going to help things like REITs, which we've already been talking about. We've already seen the move up in REITs. I mean, you look at a stock like Realty Income up 15, 20% just in the past month alone. Vici, Prologis, all of these companies over 10% gains in the past month alone. Something we've been talking about. It's not when rates start to happen. It's when the discussion of rates cuts start to happen from that standpoint. Not when the actual rate cut happens, but when the discussion, hey, there's a high likelihood, which is pretty much in the camp with where we're at right now. There's a high likelihood that rate cuts will happen in September. I want to put it at a 99% rating that rate cuts will happen in the September meeting. So that will relieve a lot of pressure for real estate. That's going to start bringing down also another thing to think about in terms of the market upside is that's going to start bringing down a lot of those high yield savings accounts, which are tied to some of these Fed funds rates overall. So right now, maybe you're earning 5.5%, but it's pretty much risk free. Well, when that drops down to 2.5%, that might not look all that enticing, especially for those in retirement, where they may start looking to go back into REITs. Hey, I like that 6% on Vici because there's not only do I get that high yield, I get the upside potential on the stock. That 5.5% on realty income looks pretty juicy, and I get the potential upside on the stock, so on and so forth from that standpoint there. So Agree Realty, Vici, Realty Income, all fantastic. PLD, EQIX are all names that I like as it pertains to the REIT world there. So what REITs are you guys purchasing right now? Let me make sure I'm not missing anything in the comments right now. NVIDIA, good choice on EPD, which was right up here. What else we got? AFL is a beast. I don't know about you guys, but my food prices are still rising over here. And food prices did, in fact, go up. There was a report in that, let's go back to the CPI report, where we were talking about food prices actually climbed 0.2%, while energy was flat. And some of the key items that were rising, I found that in the report. Let's find it right here. See if, where's that? Right there. Most notably, eggs were up 5.5%. Cereals and bakery items, something that, I don't buy all that much, 0.5%. I eat eggs. I don't eat cereal. So that's going in the wrong direction for my household. Dairy and other related products fell 0.2%. So eggs was a big one overall. So if you're buying eggs, you probably noticed a slight uptick overall month over month from that standpoint. So you are correct. And we're not going to really see those food prices come down. That's the part that kind of sucks, is we have the inflation, which drives prices higher, but then they're just going to kind of stay stagnant, because remember, we're comparing to last year, that year over year gains. And again, those things are up 30 plus 40% over the past 2-3 year period from that standpoint. And so now we need wages to catch up from that standpoint to make it look like it's not all that expensive. So what REITs, though, are we buying? Let me know in the comment section. We got Jeff's buying some O. All right. We got Cindy buying O, Agree Realty, and Vici on the weekly. Frank wants to add more Prologis and American Tower. Not sure the valuation, though. What do we got? 3M for Duck. What do you think about TMF and TLT? Don't own either of them. Never have. Probably not something that interests me all that much. Do you worry about deflation at all? Good question there. At all when you look into CPI data in more detail. I think it's going to kind of be, I'm not as much thinking about deflation as much as I'm thinking about stagflation, where it's just going to kind of stay muted for a while in terms of prices before we'll hopefully return to kind of a normal 2 to 3% climb moving there. So not really hoping, don't want any deflation because that's going to, entirely mean something completely different for the economy overall. All right, what else do we got here? King David said they released gas reserves to drive down energy prices for the summer. Gas prices are still high here. Matt, good to see you. My man eats clean. No cereal for me, my friend. Trevon, Mark, what do you think about ESS? All right, let me take a look at ESS, folks, and let's peek at ESS. Not one that I've held recently, but we have, in fact, dipped into it before. So for those of you unfamiliar, Essex Property is a apartment REIT. So the thing I like about ESS is they have some fantastic properties. If you haven't checked them out before, go to their website. And these are, not just your normal apartment. These are kind of like these high-end, think of high-rise, like, not all of them are high-rise, but think of that in terms of luxury apartments. So the customer base that they attract to a lot of their properties are going to be more of the affluent customer base. I think that they post kind of the average household income as it pertains to a lot. That's in their investor relations. They don't put that out on their website or whatnot. So you'd have to go find that type of data from there. So I like that aspect. However, we just talked about shelter costs, and that was one of the biggest impacts on overall inflation. And I think rent has climbed so much that that's one key area that just has to cool off. That's one key area where, if anything, it does have to have prices drive down a little bit lower from that standpoint there. So for that reason, I'm not investing in any apartment REITs at all right now, whether it's AVB whether it's ESS from that standpoint, just kind of taking a break and letting things cool off overall. But good question. Definitely one to keep on your radar long term. OHI and AGNC. Jim Betts, Agree Realty was upgraded to 2 buys and 1 strong buy in Seeking Alpha. We'll be adding ADC in the coming weeks. That's one I like a lot. And for those of you unfamiliar, ADC I like to refer to as kind of a smaller sibling, not quite younger. They came public at the same time Realty Income came, but they're built very similar to that of Realty Income. But when you look at the top tenants for both Realty Income and Agree Realty, you're going to be way more impressed with Agree Realty. Now, there's still cracks in both of them, but I like at the top you have for Realty Income, CVS, Walgreens, Dollar General, not companies that excite me all that much that I believe, hey, these are companies that are for sure going to be around long term. Walgreens was at the top. That company has completely fallen on its face. You go to the other side of the spectrum here and you look at Agree Realty, look at their top tenants. You have Walmart and Tractor Supply. Those are 2 companies that I do expect to be continuing to not only thrive, but be around for a long time. And the company has even more exposure to those top tenants there. So that makes me believe that I like Agree Realty moving forward. I think the growth potential is a lot higher for Agree Realty. It's much more difficult for the size of Realty Income and a REIT to really get that type of growth there. So Agree Realty, if I had to choose between Realty Income and Agree Realty, it's definitely going to be Agree Realty there. So awesome. Well, let's keep chugging ahead here. We looked at jobless claims. So we've seen inflation coming down. We've seen slowing growth. We've seen the job market start to weaken substantially here. And now we start to hear of even more job cuts. We've had a number of different layoffs from top technology companies. Intel, they're even getting money from the government, and they still can't figure out how to get out of their own way from that standpoint and continue to lay off part of their workforce. And today we got word that Cisco is doing yet another round of layoffs. So back in February, the company reported a 5% cut of their workforce. Now here we are, fast forward to the middle of August, and we're getting another 7% of the workforce that is expected to be cut in the coming months from that standpoint. However, earnings, they did report earnings today, and those came in better than expected. You could see they reported 87 cents. Overall, analysts were looking for 85 cents, so a slight beat there overall. Top line revenue came in at 13.6 billion. Analysts were looking for 13.5, so a double beat there overall. But at the same time, you got to ask yourself, how much did those expectations come down? So you can get these companies that beat expectations, but when you look at it year over year, the growth just isn't there. Intel has been terrible. Cisco hasn't been really that much better when you think about it. All of the things that they have access to with cybersecurity and things, but they just haven't been able to drum up the business. And it's really these dinosaur-like companies aren't performing, definitely not thriving in today's economy from that standpoint. So definitely something to look for is they're concerned about the future. They're saying they're cutting costs, and that's why they have to lay off. But that's also a sign that they are concerned. When you do 2 layoffs within a 6-month period, that's a company that's concerned about the future of the economy, about the future of their specific company in a weakening economy. And we've seen this from a number of different companies. When you start seeing this popping up from one company to the other, it starts to become a trend. We saw it at McDonald's. We saw it at Starbucks. We've seen it at Cisco. And how about we add in Home Depot now? Home Depot is a fantastic retailer, but they talk to their customers and they have specific insight to pro customers. Lowe's is more of the DIY. Home Depot is more of the pro customers. So you saw them report their recent earnings, and this was yesterday. They beat their expectations, which we can look right down here. Earnings per share came in at 4.6, pretty easy beat there overall. The analysts were looking for 4.49. Revenues, slight beat, 43.18 billion. Analysts were looking for 43.06. However, they beat expectations. Yay. But moving forward, their same-store sales are actually going to be on the decline by the end of 2024. That's not something that's great from that standpoint there. Higher costs are really starting to frustrate customers, as you could see. And it's been a major talking point, and as you could see here in the campaign trail. let me see where they were talking about. So we saw customer transactions fell nearly 2%. So that's traffic, lower traffic. Average ticket dropped slightly to $88.90 from $90. So we're not buying as many of those high ticket prices. Why? Consumers are concerned about the forward economy. Maybe they're concerned about their job. Maybe raises aren't going to be what they had expected from that standpoint there. So here's the quote that I saw from their CFO. What our customers tell their pros is, everything I read tells me interest rates are going to be lower. And we just talked about that here a second ago. We know that interest rates are going to be lower here in the next 6 months. So if I'm buying a house, if I'm doing a major remodeling right now, why would I jump in right now? Why not wait just 6 months when interest rates come down, especially if I'm doing a remodel project? I could see maybe on the housing side, because as interest rates come down, housing prices usually climb. So I can understand an argument there, but that's not the business for Home Depot. Home Depot is more concerned about those people that are doing remodeling projects there as well. So not only are they concerned about the interest rates coming down and wanting to pause on any of their planned projections that they're doing, but at the same time, they're also telling their pros that not only are interest rates coming down, but I also have concerns about the economy moving forward. And Home Depot alluded to that in their earnings call yesterday about the weakening U.S. economy here, which is primarily where Home Depot facilities are. So we're starting to see a lot of these trends overall on a weakening economy. So the last thing I want to go through with you guys here today is we're starting, it's August 14th, which they have until this period of time, 45 days after the end of a quarter end, for these hedge fund managers to report their latest portfolio. What have they been buying? What have they been selling? So we're going to look, and this will be the final thing that we'll look at in today's session, is look at some of these major popular hedge funds. What are they buying? What are they selling? So let's begin with David Tepper. I believe he's the one that owns, and correct me for you sport fans out there, I believe he's the one that owns the Carolina Panthers there. So what has he been buying, or what has he been selling? We could see here's his top positions in terms of size. He shrunk his Alibaba position by 7%, sold about 10% of Amazon, sold 15% of Microsoft, 17% of Meta, 7% of Alphabet, 13% of Oracle. All technology related from that standpoint right there, except for Amazon being consumer discretionary, but you can throw it into technology overall. He has some concerns about whether it's valuation, whether it's continued growth moving forward. But now, it wasn't just one and picking a few. It was the whole board right here from that standpoint. PDD Holdings, he shrunk. What was he buying? Oh, he bought 3% more of Adobe. And then he's bullish on China, which is kind of unique here. You know, you look at the FXI, which is the iShares China Large Cap ETF. So he increased his position by 9%, but he reduced his position in Alibaba. So maybe that's, trying to broaden out his China exposure, because you're going to find Alibaba in here. That could be the play there overall, but definitely lowered his position across the board in Magnificent Seven there. And again, these guys are a lot more, I never make trades based on what these guys are doing here, because again, they are a lot more near-term focused. The majority of them, they need to pump out results quarter in and quarter out. So I take a much different approach, where I am focused more on long-term growth there overall, entering positions at great entry points, less concerned about, being down 5-8% in a particular stock, where these guys, they need to hit quotas and things like that. So that's what David Tepper has been doing. Let's take a look at Bill Ackman in Pershing Square, see what he's been adding to. Well, and again, he's not one that carries that many positions overall. He took a new stake in Nike. I think he held this back in the day. So he's back in Nike, buying more than 3 million shares of the sports apparel company, worth roughly $229 million from that standpoint there. Here is a look at their entire portfolio. So this isn't just their largest stocks like we saw with David Tepper. This is the entire portfolio as it pertains to Pershing. See, Google is the largest at $2.1 billion. Dropped that by 16%. That's a big sell-off there. Hilton, not much of movement there. Chipotle, he reduced by 22%. Did he have some insight into maybe the CEO leaving? We'll give him the benefit of the doubt and say no. Restaurant Brands, no real movement there. Howard Hughes, no real movement there. Canadian Pacific, but two new ones. We have Brookfield, stock ticker BN, and then Nike, stock ticker NKE, both brand new positions to the portfolio. in the latest quarter. How about Buffett? Have we heard of him? We sure have. And we talked about him at the start where they added to Ulta. That stock's up roughly 15% at the start of our power hour here, but it's kind of unique in the fact that, we got word of a lot of selling as it pertains to their largest position, Apple, selling some of their Bank of America, taking profits there. But it has me starting to think, are we setting up this portfolio on a way that less about what Warren Buffett has wanted it to look like over the years and more about how Ted and Todd want it to look moving forward? Because these are the guys that are taking over the helm. These are the guys that pull a lot of the moves and pull the trigger on a lot of them. Buffett still obviously has the final say overall, but I think it's almost like we're starting to get this transition period already going here to formulate this Berkshire portfolio on how they want it to look, not having it at 50% Apple from that standpoint. So they dumped 49% of their Apple position there. Bank of America, I get. If you look at Bank of America, it was a stock trading, down in the low teens or high teens, $20 range, jumped up a large portion there. So a very extended valuation. I love Bank of America. Trimmed some myself before this came out here. Obviously, I'm not trimming anywhere near the amount that Warren Buffett is from that standpoint. But the Ulta move, let's get a check on Ulta and see where we're at as of this time period right now after word came out. So shares are up 14.5%. As you can see, they were beaten down in a big way. But these are as of the end of June. So the best price, they're underwater on this right now. The best price they could have got was around 385, low 380s from that standpoint. So we'll have to see. They're obviously underwater on that one right now. How about Michael Burry, the Big Short? You may have seen that video before. Let's take a look at his top positions and what he's been adding or getting rid of. So he's going the opposite way on Alibaba there, adding 24% to his position. Brand new positions here. Baidu adding 88%. So you can see right here a big shift into the China market overall. Hudson Pacific is a new one. The Real cut about 30% of that. And then not really familiar with either of these ones down below here. So he hasn't been the greatest of investors in the last few years here. So again, not going to put a whole lot of weight in that realm there based on Michael Burry. So any questions you guys have? That's a lot of news that we covered today. Going through CPI, going through the Starbucks change, going through jobless claims and talking about that, talking about the Fed, talking about interest rates. So a lot of great data. I hope you guys enjoyed today's Power Hour. It's good to be back with you guys. And if you're watching the replay or if you're watching live right now, make sure you guys hit that like button down below. I really appreciate it. And if you're ever interested in working with me on my one-on-one program, we got 3 spots left for our one-on-one investing accelerator program. You can see a link down below. This is the final week that we will have enrollment. So anyone that has a call set up with me, if you get a call set up with me, even if it's for next week, that's going to be totally fine because you have it locked in by the end of this week. But after the end of next week, we are going to be transitioning prices and prices will be increasing overall. So if it's something that you've been wanting to do and get in on this program, it's a great 6-week program. It's one-on-one, completely customizable. We're going to build you out a customized strategy and action plan. And then we're going to progress through the course, look at REITs, look at ETFs, index funds, how to value individual stocks, how to analyze individual stocks. And we'll go through the whole slew of our entire valuation checklist. There's a number of you that have taken the course that are on this weekly show on a regular basis and can vouch for that. So if you are interested or have been wanting to take it, I just want to give you guys a heads up. You've probably received some of my emails as it pertains to our prices will be increasing in the next week. So make sure you get a call on board there so you can get signed up. Again, we have 3 spots open and those will go rather quickly. Another thing to put on your calendar that you'll start getting some emails from me if you haven't already is we're going to be doing our next options webinar. So if you are brand new to options, you've been curious about options, that's really how the next leg in taking your investing to the next level. So we are going to show you exactly how I utilize options. We're going to go through 6 key strategies on how you can generate, starting off with hundreds, but then getting to a point to where I'm at right now, generating upwards of $5,000. That's my goal every single month, is to generate $5,000 income from option premium. So I do a lot more option selling, but we're going to go through buying calls, buying puts, covered calls, cash secured puts, credit spreads, as well as debit spreads, showing you what are the pros and cons of each, in what situation would you use them, look at some examples, and what to be fearful for in terms of risk as it pertains to options. So, look out in your inbox for dates on that. We'll have more about discussions on that next week. So we'll have a new options webinar coming your way if that's something that you've been looking to take as well. So thank you guys so much for joining today's Power Hour. It's good to be back with you guys. And with that being said, we'll see you next week. Take care.